All right, hello everyone, and welcome to another episode of the Bullish on Bitcoin show. Today we have with us Thlither, DeFi Lead at LayerZero, and the topic for today is Omnichain. So we're going to dive into cross-chain, Omnichain, and what's the hottest cross-chain, Omnichain topics, and what does it actually mean for RWAs? Where are we heading with agents? Thlither, do you want to maybe, first question we always ask, how did you get into crypto? How did you get into Bitcoin? How did you end up building essentially the underlying infrastructure for cross-chain communication?
Yeah, sure. Can touch on that. And thank you guys. Thank you, Alexei, and to Bob for having me on today. One of the things I love about the crypto space is you could ask 100 people how they got into crypto, and you'd probably get 100 completely different answers. For me, it was from the trading side. So back in 2016, 2017, I did a lot of stocks and options trading, within TradFi. 2017 or so is when I kind of first discovered that crypto was a thing. But at that point in time, I kind of just saw it as a parallel stock market, as different charts and different assets. I didn't really understand that there was this entire universe underneath those charts and tickers. Um, I graduated from college into COVID. I was going through some recruiting for different finance jobs at the time, and still doing a lot of trading. And the pandemic hit, and all of that kind of ground to an immediate halt. So I found myself with all the time in the world and nothing really better to do right as DeFi Summer ramped up in 2020. And that's when I started kind of transacting on chain for the first time. The classic days of 5-figure percentage APY yield farming and meme coins and all of those amazing things that I think those of us who have been in the space since then fondly remember. From 2020 to 2024, I basically traded, invested, and wrote research pieces full time. Kind of just challenging myself to continue to push my level of knowledge in the space forward. Writing kind of long form research on various DeFi topics. At that point in time, I met someone from the LayerZero team. Honestly, it was exactly what I was looking for in terms of continuing my journey to learn more about the space and to participate more meaningfully. I really connected with the mission statement and the ethos that LayerZero has, and I was, of course, a large Stargate user at that point in time. And yeah, it made sense for me to dedicate myself to this, and I've been on the team at LayerZero leading our DeFi vertical for about the past 2 years or so.
All right. Well, I mean, you've been around, I think, some of the most interesting times for DeFi. And naturally, the emergence of so many new L2s and chains all competing for liquidity, everybody throwing out incentives, right? You were mentioning, right, these hot APYs, yield farming points. And ultimately, DeFi degens have to move between chains, right? Like we all talk about the future where users will no longer know which chain they're on. And, you can already do that quite well. And underneath, assets are moved around. And, with USDT0 or WBTC that are both powered by LayerZero, you have essentially this abstraction available to wallets and users. But for power users, for, funds, institutions, they still really care about, which asset is on which chain and how to actually move these assets around. What's the canonical bridge? And the main topic I think we want to talk about today is, the trade-off between maximum reach and minimum trust, because my background actually is in cross-chain bridging as well. I come from more of an academic background. For those of you who didn't know, one of my PhD actually focused on cross-chain bridging, but not just like the implementation side, but the fundamental question of, okay, what does this mean from distributed system and security perspective? How do we build cryptographically secure systems that allow us to move assets between different chains? We proved that fundamentally trustless cross-chain communication is fundamentally impossible, in fact, I was quite sad because my whole goal for my thesis was build something fully trustless, and we realized, yeah, it's not possible. You always have to trust someone or something. The best thing you can do is if two chains fully can verify each other and you only trust that, let's say Ethereum and a layer 2 of Ethereum or like, you know, Ethereum and I don't know, Solana both kind of are operating securely. But these things come with a trade-off, and you can't have both. We, you know, from Bob's background, you know, we build trusted anonymous bridges for Bitcoin, and you always have this decision that you have to make. Do you build something that users can use, or do you build something that's super secure and the maxis will love, but it's actually unusable? And I feel like LayerZero has this very flexible framework. So, you know, maybe, you know, let's start with a more open question. How do you see the space evolving between maximum reach versus minimum trust? And where do you think we're currently heading? In which direction do you think cross-chain protocols and essentially the users and institutions are going right now?
Yeah, for sure. So I guess the first point I would make is that for those of us who have been in this space for 6 or 7 years, I think we all remember what bridging looked like before, you know, the kind of current slate of different options for interoperability. The memory that I have burned in my head was a certain token that did not exist on Ethereum mainnet, that had about $750 million bridged over in like a very simple wrapped token bridge, that, you know, was essentially owned by one person's multi-sig. And I think like I guess would just like to highlight how far we've come since then, and how much safer we can feel about cross-chain assets today. To answer your question more directly, though, I think that there is a balance of the two that is very much so needed in the world of interop. So, starting on the subject of reach, I guess the big question there is like, why would an asset issuer actually want their token or tokens to exist across, you know, 5, 10, 15 or more chains? The answer to that is pretty straightforward. It's because people need to bring their assets to the users, to the applications, and to the different use cases, that are native to each chain. So, like, if you look at the set of users on, say, you know, Ethereum mainnet versus Solana versus Plasma versus Arbitrum, there's so much differentiation between the activities on those chains that drive flow, that drive volume. And asset issuers today just can't afford to, you know, make a bet on a single chain as their end all be all environment for all on-chain activities that they're engaging in. It's more important than ever, especially getting into, you know, things that are big in 2026, like RWAs, tokenized equities, et cetera. These things need to exist where users have their capital. And so I think that, you know, whether we go in a direction where in 5 years there are 5 million chains that people do things on, or five chains, I think in either case, it doesn't really matter. You'll always need to have reach across that set of chains. So you need the reach, but obviously security is one of the most important topics in crypto today. Um, the way that we think about security at LayerZero is to give as much customization and configuration potential to the issuers that work with us as is possible. So, you know, an example of that, we work very closely with the teams at PayPal and Paxos on PYUSD and a couple other assets. Um, PYUSD is a NYDFS registered and regulated security. And so there are certain bars that they need to be able, boxes that they need to be able to check out, in terms of how they set up their security between chains. So for us, that means giving people, you know, optionality and multiple layers of coverage when it comes to security. We have, you know, the verifier piece of the protocol, something that we call decentralized verifier networks, or DVNs. You know, the bigger asset issuers that we work with use a set of 4, 5, 6 DVNs. A lot of them, like, you know, the team at USDT0, for example, actually chooses to run their own DVN with, you know, custom logic, with security monitoring, and all of these other checks and balances that they can, you know, use to make sure that their bridges and their interop is as secure as possible. And at the end of the day, I think, you know, crypto will always be an adversarial space where people are testing security models and trying to poke holes in them. And what we aim to do is to layer redundancy, and give the issuers that we work with as many tools as you know is possible for them to create bridges that are safe but also very efficient, and you know, with the reach that they need to access their users on the chains on which those users exist.
I think, one of the topics we have to talk about and kind of, view like cross-chain bridging from this angle is institutions are coming right into crypto, into DeFi. We're seeing this shift. And it's, to be fair, it is an emerging debate of whether the future of on-chain finance will be embracing institutions and basically becoming part of TradFi. And there's a lot of reasons for this to happen. And to be fair, I think that's going to happen no matter what. It's a very safe bet to make. Institutions are coming on-chain. On-chain finance is more efficient. It's composable. It has a lot of advantages. They want the blockchain infrastructure, right? But then you have the group around, Aave and these core DeFi protocols that are still like, basically, it's not a very popular narrative right now, but it is essentially the reason why we're all, and most of us have remained in the space, is building a better system, a decentralized system that can operate in parallel to TradFi and actually offer an alternative and more competitive system, a better system than what we have today with banks. And I think one of the interesting points here, both of these groups will make very distinct decisions with respect to their cross-chain strategy. What's your take? Like, how do you think, if at all, these strategies differ between an institution basically viewing like just the crypto space as blockchain and they just want to deploy it and make it available on chain versus something DeFi native like Aave that is very selective and strategic with their cross-chain deployments and their cross-chain strategy here, or like on-chain asset issuers that maybe decentralized stablecoin CDPs and so on. Like, do you see different takes, different flavors of their cross-chain strategy when LayerZero engages with these teams?
Yeah, so I guess first of all, I would say I'm a very strong believer that as this space grows up and as more institutional players, deploy assets and apps on chains, I think there will always be open permissionless crypto and more regulated KYC permissioned crypto. I'm not sure that the two will ever conflate into the same category. I think that there is more than enough space for both to coexist. Using a specific market segment as an example, right? Like Hyperliquid. Hyperliquid is an open permissionless exchange, and they have found unbelievable PMF in trading to the point where there's price discovery for commodities, for stocks that happens within their order books. At the same time, you have all of these massive institutional players. I mean, the DTCC yesterday gave a huge update on the progress of their fact finding and proof of concepts that they're deploying on chain. And I don't think those will ever morph into the same thing. I think there's enough space for both to exist at the same time and serve different user personas. So getting into cross-chain strategy, right? Like I think it's honestly more use case dependent than it is, open/closed dependent. For example, for exchanges, whether you're a Hyperliquid or a future, say a New York Stock Exchange that exists on a blockchain, you'll always need to source liquidity. You'll always need to create pathways for that liquidity to flow in from not just one chain, but from many chains. And because of that, I think there will always be a need for interop that under the hood doesn't look that unbelievably different across the open stack and the permission stack. For other things like stablecoins, CDPs, lending, I think it follows more or less the same form factor, right? Where like all of the things that I kind of opened with about, reach, about using or transporting, I guess, your assets to the environments that users actually have capital working on. I think those will be prescient for as long as people are still building things on blockchains. It's just a question of packaging. For tokenized equities, for CDPs, for RWAs, private credit, like all of these things on blockchains face the same problems that they need to solve. And I think that, yeah, as a solution to a lot of those problems, sourcing liquidity or spreading assets around different chains is something that will always be super important.
And you talk to so many companies in the space, right? And different players. What was the probably, I mean, to kind of I'm trying to get, always some insights and like things that, perhaps happen behind closed doors. What was the most surprising insights or like request, ask opinion from institutions coming on chain that you've seen in like the recent months? Like what was anything that really surprised you, that stood out, something unexpected?
Yeah, I think something interesting, a cool story to tell. So I'm very bullish on vaults in general. I think that, the things that like Morpho and Aave and Upshift and Veda, that those guys are doing, it's such an intelligent use of blockchain to basically create, a vehicle that's open and permissionless that can take one asset or many assets and that can use that collateral to generate a yield that's passed on to holders. But I think us within DeFi, we think about these things in a very like blockchain specific way where, you're asking, does it use 4626 or 7540? Is it a vault that exists on one chain or many chains? And some interesting conversations I've had. I've talked to a few hedge funds and family offices that are very much so not crypto native, but who are, paying attention to what's happening in the space and wanting to, learn more and potentially build things. And one of these funds referred to vaults as on-chain strategies. And I loved that framing so much because it doesn't like necessarily occur to us who are spending all day in DeFi and crypto, but the way that they see vaults is essentially as a fund, using like TradFi lingo, as a fund that is open and permissionless. So like rather than deploying a strategy, equities or private equity or venture or whatever it is that they're trying to raise money, use that money to generate a return for investors. Um, Seeing that they're interested in like deploying that on chain using 4626 or another very DeFi native concept, but framing it in a way that makes sense to people who maybe don't have the experience building in the space and transacting in the space, I think is not only cool, but it's very emblematic of, in general, the way that these more like financial institution and banks and people of that nature are thinking about blockchain today. It's not necessarily like a way for them to deploy like completely new conceptual ideas that they haven't been able to deploy. It's a way for them to take what they're doing off chain and make it more efficient, make it more widespread, make it easier for people all over the world to participate in these activities. I think a great example of this as well is Echo.xyz, which, for those who don't know, is a app that Coinbase recently acquired that basically crowdfunds early stage investments into startups. There are crypto startups on there. There are, TradFi startups. But what they've done is take something that is, in TradFi, a very, very high friction thing. To invest as a venture investor into a private company off chain, there are so many different hoops that you need to jump through and setting up SPVs and legal contracts and all of these things. And they've taken that and in a compliant and straightforward way, they've packaged that in a modality that like anyone can participate in. And I think that using that reasoning and kind of applying it out to other things that have yet to come on chain, like right now, tokenized equities are huge for investors outside of America who can't necessarily like open their E-Trade or their Charles Schwab account and just buy SPY or SpaceX or whatever stock. But you're seeing it with all types of other assets too. You're seeing it with private credit. For example, we work very closely with the team at USDAI, and they are essentially using the collateral that's deposited into their protocol to underwrite hardware loans to budding AI infrastructure companies and finance hardware for those companies. And like, if you think about what it would take for me or you, for individuals who don't work for an investment firm to participate in that activity off chain, it's so much more frictional than swapping or depositing into a stable coin or another tokenized instrument on chain today. So that's super exciting to me. And I would look, hopefully we get clarity pushed through in the next couple of years. And when that does happen, I think that will be a great show of confidence that it is okay to build these things in production. And I'm very, very excited for that day to come.
And I find vaults very interesting, and because they essentially, when you look at vaults, under the hood, there's like two types of vaults, right? There are vaults that are on-chain strategies, really, and these are really like DeFi native. They deploy into Aave, Morpho. You could argue that Hyperliquid is kind of like somewhere in between, right? But there's not that many, right? The liquidity is still quite thin on those, right? I mean, just because the yield opportunities are not as big on chain right now today as they used to be. There's not as many incentives, right? So it's not as easy to run strategies on chain as it is off chain. And the other category, and that's where the most liquidity is basically basis trading, options trading, and other strategies, tokenized money market funds. We've seen private credit funds, right? Basically tokenized on chain, but because basically that's what these vaults are, right? It's just a way for you to deposit. So essentially what these funds and institutions are doing is they're essentially taking up the complexity of depositing into their funds. So they're using on-chain vaults as distribution, which I find quite fascinating, right? Normally we say, oh, crypto has to fight for distribution, and then we need to go to the TradFi guys, the investors. But actually you see that, from their perspective, it's much easier for someone to just make a wallet and deposit on chain than to sign up with a brokerage or whatever, go through that process. And obviously, I do hope that in the future, right, we can use this on-chain, because the liquidity that is actually deposited, it gets taken out of the chain, right? It basically does something on centralized exchanges and whatnot, or it's on hyperliquid, which is somewhere in between. But what a lot of these vaults then do, if it reaches a certain scale, they tokenize it, right? And Athena is a good example, and there's others, right, where these assets are then tokenized and you can use them as collateral in it for other strategies, benefiting from composability of on-chain finance. And to be fair, I see vaults still with I think it's necessary to also apply a critical view to this. The majority of them are off-chain strategies where institutions basically are hoping to get more people to invest, and it's a vehicle for them to just get access to more non so sophisticated investors that find it easier to deposit and deploy on chain. But I do hope that in the future, and by more liquidity flowing into these off-chain strategies, if they're tokenized back on chain, you can do something with these assets, right? You can use it on Pendle and other things. That contributes to the growth of yield opportunities on chain. But yeah, I would still see. I personally, sometimes a bit skeptical of vaults, because at the end of the day, liquidity gets sucked out. Actually, if you have to pick between a vault or depositing into Aave, you're actually, if you deposit into Aave, you're contributing to on-chain liquidity. If you're depositing into vault, often the capital gets actually taken out. But again, at the end of the day, on-chain liquidity is still thin, and a lot of strategies just require you to run it off-chain, and it gives you more flexibility. Maybe a final kind of take on this, taking a step back and talking more generic about interop. What will be your most controversial take about the state of interop today? We want to hear some spice. You've been in the trenches, you've seen what's going on, you've seen what's possible, what's not possible. What's the most controversial thing that you're seeing right now in the market?
Well, I think the nature of interop has changed a lot in the last 3 years. And when I say that, I mean, who the market participants who are really driving volume within interop. I think if you go back to 2022, 2023, there were so many on-chain games, I guess you could say, to play as a general retail market participant with assets in crypto. There were airdrops to farm, there were crazy yields to access, there were 50 different L1s that people thought maybe this is the next Ethereum, maybe this is the Ethereum killer. And I think the space has consolidated considerably today, but it's also matured in the types of actions that people actually need to drive the transfer of assets from one chain to another chain. I guess to be more specific, we see so much flow today from exchanges rebalancing inventory, from market makers, from asset issuers and apps who are using LayerZero to send 8-9 figures between chains for the cost of gas. And I think seeing a transaction like that in 2022, for example, when Plasma launched, we saw somebody bridge $800 million in USDT0 into the chain. Seeing that type of transaction in 2022 or 2023 would have been super, super rare, but these days it's something that we see a lot. And I think it, to jump off something you said, I think everyone who's been in this space for more than a couple of years has seen how much it's grown up, and it's become more institutional. It's become more of a fintech feeling thing than, you know, I guess 5 or 10 years ago, and it was super cypherpunk and, you know, outlaws doing things on chain with crazy end results. I think what's important about DeFi today is composability, is the, you know, ability to access users all over the world, and, you know, the I guess, ability to do that without super centralized institutions controlling all of those flows. And yeah, when you look at volume today, I think my spicy take would be, it's very emblematic of the fact that the space is institutionalizing, and it's less, you know, games for retail participants to play, and more so like serious actors who are needing to move money in the most capital efficient A from point A to point B.
Cool. And I think so. So would you say essentially that, you know, like, I mean, I saw you just recently posted, right? LayerZero did $19 billion in 30-day volume. And how much percent of that would you say is DeFi natives? And how much percent of that is really rebalancing institutions moving around assets between different chains to kind of where assets get deposited and then withdrawn again? Like, how would you say the split is right now, if you had
You
to
know,
estimate?
it's always hard to say. I'm gonna challenge your usage of the term DeFi natives. I think as these
I guess,
institutions
yeah.
do things on
Yeah.
chain, they become DeFi native, right? Like if you deploy an asset onto a blockchain, you immediately start looking at what that asset is actually capable of. And there's so many examples of this, protocols that set up morpho vaults or get Pendle integrations or whatever like that second order kind of use case is. I think, you know, it really depends on the month. Like there are some months where we deploy on a new chain and we see a ton of retail driven flow. There are other months when, you know, the market's down and asset prices are down when there's less retail driven flow. But at the end of the day, I think like what's most important for us rather than distinguishing who is driving that flow is to make sure that every single type of market participant has, you know, an excellent experience bridging assets from you know, a source chain to a destination chain. um, you know, when you look at like the different ways to move assets around, there are ways that are fast but not capital efficient. There are ways that are fast and capital efficient but very much so centralized on, you know, an independent third party that you need to trust. Like for example, an OTC swap would be something that falls under that category. But where I think we excel is that like with layer zero, when you're transferring OFTs, it is super capital efficient. You know, in pretty much all cases, it's 1 to 1. You know, I bridge $10 from one chain and I get $10 on the other chain. But it's also like the trust assumptions are, you know, in my opinion, as decentralized as you can get within interop today. You can be relying on verifiers that are, you know, in different parts of the world, that are running different clients on their verifiers, that are using different cloud providers, so that if one you know, party has an issue, say like AWS goes down, a protocol that's 100% dependent on AWS or Google Cloud has problems immediately. But when you spread those trust assumptions out across different providers, I think it creates just a really robust system that is able to service, you know, Bob in retail. Bob is the name of your chain. I'll pick a different name. Carl in retail, who's bridging $15 in Tether from one chain to another, but also some crazy sophisticated actor like a market maker or curator who's bridging $100 million from one chain to the other. I think providing an equally good experience for both of those user types is something that we focus very hard on here at Layer Zero.
Moving the conversation a bit more in the direction of Bitcoin, naturally we're biased. We are, you know, you could call us Bitcoin maxis because we've been building on Bitcoin for the last decade. We don't really, I guess, count to the, you know, laser eye maxi camp because we've always built on the intersection of Bitcoin and other ecosystems. You know, LayerZero partnered with, you know, BitGo and RapidEC essentially to help distribute RapidEC across different chains. RapidEC for the longest time was very slow in the multi-chain BTC race. You saw other wrappers essentially launch and basically capture these newer chains and capture these markets because it was so hard to get RapidEC natively deployed on these other networks. How has that evolved over time, right? You have, you know, RapidEC on Ethereum, you have RapidEC on Tron, you have RapidEC mean, I don't even know, it's like 11 networks, I think, or more, where you can now easily access it through LayerZero OFTs. How do you see, Bitcoiners interact with RapidEC? Do you see a lot of volumes moving on, like between different networks? Is it still quite consolidated between ETH and primarily like maybe, I don't know, Tron? And how do you also see the kind of experience and how much flow do you see actually coming from Bitcoin? I know it doesn't happen directly with LayerZero, but I guess you do see the movements in the backgrounds to some extent.
Yeah, for sure. So I guess going point by point. So WBTC today is on 21 different chains. Some of those chains were pre-existing before we started our work with them, and some of them have been deployed in the last couple of years since we have been supporting them. Something that's very cool about LayerZero, and specifically the way that we worked with the BitGo team, there are certain assets like WBTC that before they have interop with LayerZero that already exist on a set of chains. There is a way to deploy a bridge using OFT, which is our Omnichain token standard, that essentially negates the need to like deploy new token contracts on those chains. So when we deployed with WBTC, there was no liquidity migration that needed to happen. There was no rebalancing and exiting one flow to enter the LayerZero flow. They just were able to plug in what we do and use the same set of chains that they already were deployed on. So I think that's very cool. In terms of flow, yeah, we do see it move around. Of course, Ethereum mainnet, in my opinion, is still the hub on chain for size, and so a lot of the volume that we see from them goes in and out of Ethereum mainnet. But across chains like Monad, like Base, like Starknet, Hedera, all of these networks that have the need for Bitcoin native assets, for rather like assets that are trusted and that track the price of Bitcoin. I think that is super positive, and it is very telling in terms of the thing that I talked about earlier about reaching your users where their capital resides. On the Bitcoin side, I think they're I'm also a Bitcoin maxi, so we definitely get along well with the guys at Bob. But there are, I think, more questions around Bitcoin today than at any point that I can remember in recent history. There is the conversation of how quantum breakthroughs will affect encryption. What do you do with the tokens in Satoshi's wallet? Of course, MicroStrategy is another exterior factor that a lot of people talk about, and all of these points that people make, as well as like a pretty unfortunate downturn across the entire crypto market in terms of prices. But through all of that, we still see the TVL in terms of Bitcoin of WBTC grow, which I think is very bullish in terms of the way that people with capital really think about Bitcoin. And yeah, the BitGo team, they are awesome. They are the best in the world at what they do in terms of bringing Bitcoin to any chain that has the need for that type of asset. And it's been a pleasure helping them expand and working with them over the last couple of years.
One of the things that we work together with LayerZero and BitGo is bringing more BTC into DeFi and making it easier for users to go from Bitcoin into WBTC. Because one of the limitations of WBTC has always been that, well, you have to buy it on chain or on centralized exchanges. Very few DeFi users are like, you could call them like normies, non-institutional users, can actually go and mint it, right? Minting is done through merchants. And it has not hindered WBTC growth at all, right? WBTC grew from a few hundred to a couple of hundred thousands. I mean, at its peak, it was 200 something thousand BTC that was minted on chain, and primarily initially driven through MakerDAO, using it as collateral. So it hasn't really been a hindrance in the past. But what the feedback we've been seeing is, well, it is quite a pain. If you have Bitcoin, like what's the best? How do you actually get WBTC? And you can go to centralized exchange. You can actually just go and like buy it in DeFi if you have stable coins. But if you have Bitcoin, you're quite restricted. And that's why when we launched Bob, one of the first things that we did with our cross-chain intents protocol was, okay, allow people to go from Bitcoin into WBTC. I think we supported 11 chains at that time. How do you see Bitcoin Bitcoin or DeFi evolving? Do you see more people committing to WBTC and just staying in WBTC, holding the long-term Bitcoin in WBTC? Or do you think there will be an increase of, mint and burn? I mean, certainly it's something that, WBTC and BitGo want, because that's also one of the revenue streams, right? It's like the mint and burn fees. How do you think people will actually go in and go out? Like, what, I mean, we have an opinion of that behavior, but I'm curious, from LayerZero's perspective, given that, you see a lot of the WBTC movement, do users, from your perspective, go from their off-chain Bitcoin into on-chain DeFi, do their thing, and then withdraw? Or do you see more a theme where people just commit to having a wrapper and accepting that this is, the best way to do DeFi with Bitcoin, and the alternative is, if you want to do something with Bitcoin, you have to go to centralized exchange, and then it's also a wrapper at the end of the day. But in DeFi, at least, DeFi itself is transparent. Yes, you have some assumptions about the custody of the wrapper, but you have that no matter what you do with Bitcoin. So it's just a given.
Yeah, I think we do see a lot of sticking. I guess to start at a higher level, I think to overgeneralize, there will always be kind of two different sects of Bitcoin holders. There will be, group one that sees it purely as a non-usable store of value. People who hold their Bitcoin natively on Bitcoin, who have it in a hardware wallet or multi-sig or an MPC, and who never ever touch it. Who see it as a hedge against, traditional financial markets and the dollar and gold or whatever asset it is, right? And those people, I think, over time have become more receptive to joining the second group, which are people who believe in the DeFi mullet, who think that, the whole point of holding assets on chain is to be able to use those assets to compose yield, to lend, to deposit into vaults, to do all these different things on all the chains that exist today. But I think once you join that second group, once you commit to, moving your Bitcoin into Ethereum or broader DeFi, I don't see a lot of people who, do that for a week or a month and then go back to native BTC. I think those people are very much so comfortable with, the kind of things that they need to learn and wrap their heads around to keep that Bitcoin in the form of, say, WBTC. Also, yeah, when you're looking at like moving your Bitcoin out of L1 to, use it to generate yield, I think that the ability to trust but verify that you get in DeFi is one of the strongest value props that exists today within the entire space. For example, if I deposit WBTC into a lending market or into a vault, I can go onto Etherscan or whatever blockchain explorer. I can check the smart contract and I can literally see that my WBTC is within that contract. Centralized exchanges just can't offer that same level of transparency. And I think that, for people who have that core like Bitcoin / crypto ethos and want to be able to know exactly where their assets are and what they're doing at any moment in time, 24/7, 365, I think that, yeah, DeFi is a place where you can have those guarantees. Maybe not, with 100% confidence in all cases. There are, crazy things that happen in DeFi, but at least you can know that your assets are where you think they are. And I think, for people who hold these types of assets, especially in size on the retail side, that's something that is super, super valuable.
Yeah, I'm just pulling up some stats that we have, because, like, if you look at, cross-chain protocols that offer Bitcoin swaps, naturally, when people trade BTC, they primarily trade it against, surprisingly, ETH is the number one pair if you trade like native Bitcoin against assets on Ethereum or other chains. Number two, naturally, are stablecoins. But WBTC is in the top five. Actually, if I look, to be fair, I stand corrected. So over the last 6 months, the number one asset pair was Bitcoin to USDT. Number two was Bitcoin to WBTC.
Oh,
No,
that's not
sorry.
surprising to me.
Number two was ETH, and number three is Bitcoin to WBTC. So you do
Yep.
see, like, and that's something that we find quite interesting, is that people do want to get in and get out. Naturally, there's two types of groups that actually trade Bitcoin on chain, like that one native BTC. It's people cashing out, so like actually buying and selling Bitcoin for stables, So taking profits out of DeFi into Bitcoin and just moving it into the ledger or into the, like basically off chain. So people who already use the ledger, for them, if you're selling Bitcoin, why would you hold it in WBTC? If you're holding WBTC in your ledger, you might as well hold Bitcoin in your ledger, right? If you're at that level of sophistication, and as wallets mature, as multi-chain wallets mature, there is no real reason for you to hold WBTC if you're not using it. It's so easy to get in and get out at this point, especially if you use things like BOB. And the other group are DeFi power users. And it's quite interesting when we see people move Bitcoin to WBTC, if you follow the transaction, because you see it all on chain, right? It's always into DeFi. Aave, more for yield basis. Like people don't just hold it. So it's like very two distinct user groups. And we think actually, from the demand that we see from our integration partners, like there's a lot of ask for, larger capacity of swaps. So like essentially being able to process like $1 million plus in Bitcoin, because primarily the institutions and the whales that, come from Bitcoin, they want to do size, which I find quite interesting. It's a quite different market to essentially what you see when people move like WBTC into DeFi on chain, right? I think the amount of that people want to move from, like, if people move large amounts of BTC, they will move it into DeFi to have it there to use it. But then if they don't use it, they will want to move it back. So that's something where essentially the integration that we have with WBTC through LayerZero is actually very powerful, because it allows it to go from Bitcoin into any DeFi protocol with one click, right? So it's routed through BOB Gateway and then through LayerZero WBTC. And you can go from Bitcoin into Aave with one transaction on Bitcoin. You don't need to think about gas or anything else, and then you can go out. And it really just abstracts actually DeFi for them. It makes DeFi feel like a centralized exchange, essentially, because you don't need to deal with like which chain I'm on. But from a Bitcoiner, actually, it makes it more accessible, which we found is actually quite attractive for many BTC holders.
And
but
I think
enough
you
of.
hit the,
Oh yeah, go ahead.
I was just gonna say, I think you hit the nail right on the head there. I think there are people who want to take their native Bitcoin and use it within DeFi, and you always see them. They don't just hold WBTC; they deposit it, they lend it out, they use it to generate yield. But also, I feel like there is, and probably a huge volume driver for you guys, there is another sect of people who wants to cash out or cash in, right? To take their Bitcoin and end up with stables, or to take their stables within DeFi and end up with Bitcoin on the ledger. And that seems to me at least like a massive service, a massive problem that you guys are solving, and letting people do that in a permissionless way where they don't have to deposit to a SEX or use an OTC desk or whatever, more centralized way. And it is interesting that the number one pair that you guys see is Bitcoin and USDT. That's really cool. Thank you for sharing that.
Yeah, I mean, it's surprisingly, I mean, it actually is just flipped ETH before, up until like 2 months ago. It was actually like, if you look at the 6 months horizon, it was Bitcoin and ETH, which I found very interesting. Essentially, Bitcoin and ETH whales, essentially people diversifying the portfolio, going between the two assets, essentially like making that bet, which I find quite fascinating, versus Bitcoin to USDT, Bitcoin to dollars is the number one pair on centralized exchanges as well.
Yep.
But yeah, the ETH one was quite interesting and still is. So, talking about users and people, I think one of the more interesting angles and something that kind of I'd want to, spend the last few minutes talking about, are agents. Agents
Yes.
naturally they're neutral in the sense of they're not emotional. They act in a very rational way based on however you parameterize them and whatever data they're operating off. And one of the most interesting studies I've seen around Bitcoin and AI agents, right, is that a lot of models will pick Bitcoin as number two behind stablecoins for settlement, for payments, even for payments, right? Like stablecoins, number one. But they would pick Bitcoin as number two for a lot of these things. Store of value, naturally, Bitcoin number one, investment, Bitcoin number one. But even for payments, for settlement, for remittance, Bitcoin is like was ranked number two. If you ask like these models, like, hey, rank it, give me the top solutions. Fiat is like somewhere down in the back. How do you see, I mean, perhaps not just limited to Bitcoin, but overall, how do you see AI agents changing the way cross-chain bridges are built today and the market here? We talked a lot about institutions, and what they want and what retail users want and how end users experience cross-chain. What do you think will change in the next 5 to 10 years assuming that agents take over and we see more people essentially automating their personal finance, institutions automating their activities, strategies being automated through agents. Instead of you depositing into a vault, your agent is copy trading someone else's, but your agent always has custody, right? There's such a big design space, and naturally cross-chain communication will be a very big part of that, because ultimately you got to move assets across different networks. What's LayerZero's position there, and what's your opinion? Of course, you can choose to answer this from the official stance, or of course your personal
Well,
position.
I'll give you both. Start on the personal side. I am incredibly bullish on agentic activity within crypto. Crypto at the end of the day is programmable money. It's money made into a software that you can send, you can use to generate yield, you can use to trade, all of these different things that exist on chain. And I think it makes perfect sense for agents, for the most exciting type of software in the world today, to use the most efficient form of internet-based money that exists in the world. I don't think there'll be, robots will be going to ATMs and hiring couriers and, running money across the country. I think they will use blockchain to transact and to trade and to, store value. From the LayerZero side, I think, first of all, the agentic space today is so nascent. There are protocols that are, creating flows, packaging of different types of activities on chain that are usable by agents. There are, full on decentralized AI protocols like Venice, for example, that believe that, data stored from your interactions with AI should be decentralized as well. I think the most important thing for us is making sure that, again, we can give agents, especially when it comes to moving actual dollars between chains, the most capital efficient way to move money as is possible. So we do a lot, of course, on the messaging based bridge side. We also do a lot on the intent side, for kind of smaller size transactions where latency is a huge concern. But I think in terms of interop, just giving, anyone using agentic workflows to transact in crypto a bunch of different ways to send that money around is very important. But that being said, I expect the agentic space, especially like the bigger drivers of what I think will be future agentic activity on chain, like payments, like trading. Copy trading is a great one that you mentioned. The advancements in those space are still so very much so ongoing that, like, for us, I think the official company line would be that we're watching it very closely and with a lot of interest. And when those main drivers of volume begin to kind of differentiate themselves and emerge, we will absolutely make sure that we have the necessary, not only modalities of value transfer, but the, tooling needed to make accessing those flows as easy as possible for agents. I think, yeah, it's incredibly exciting to see the progress when it comes to, computer driven transactions within crypto, and it's something that our entire company is watching very closely.
Nice. Well, I mean, I think, we're bullish, I think. And the interesting thing is that, Bob is not necessarily like an AI focused company, hasn't been so far, but just from internal use and, with the way we interact with the BOB Gateway trading platform has been very much AI driven. We've been very early started experimenting with AI agents internally, and actually recently launched the Gateway CLI, which essentially just allows you to start trading Bitcoin against any other assets. It makes it super easy for agents just to handle that without, dealing with the complexities and figuring out like how to build your own transactions and whatnot. It just, goes out of the box. You plug that in, and your agent now can buy and sell BTC against any asset that we support on the platform. And so, yeah, we're naturally very bullish, and we have actually been experimenting with some cool new things where it's adjacent to Bitcoin, but we feel that, strategies can be better run by agents than by humans to some extent. Like, I think you need a mix. But we've already seen some very early interesting results from just, plugging in agents into cross-chain protocols, CLIs, and like letting them trade run DeFi yield strategies within some constraints, and just, benefit from the fact that, you have arbitrage opportunities across different chains. There is like so much flexibility between like, DeFi different protocols existing on, you can run a strategy that combines hyperliquid, something on based on Ethereum and Solana, and your agent doesn't care. You don't have to worry about this as an end user. And I think agents will do a lot for cross-chain abstraction. I think we always talked about, well, the user will not care and they will not see where their dollars are at. I think agents will actually accelerate that, because for an agent, right, if you have things like Gateway CLI, I'm sure there's others, like I'm sure LayerZero has something coming up already live. I'm sorry, I'm not educated here. That makes it much easier for agents to plug in. I think that will just accelerate the use of cross-chain protocols, and B, it will just make it so much easier for people to interface with DeFi without thinking about which chain they're on, because the agent will just handle it all. And agents really don't care, right? Like if you have a way to move assets between two different chains, it's the same to the agent, right? Whether it's same chain or cross-chain, they don't care.
Yeah, I completely agree with you. I think the ultimate end state for crypto is complete abstraction for users. If we ever want to serve people who haven't, been DeFi natives for the past 5 years, like you can't have people needing to manually send their money between Base and Ethereum and Solana. You just want that money to be put to work in the best possible place for it. And I think agents will play a huge part in that. In terms of LayerZero, there is some top secret stuff that I can't tell you about today, but I think, in the next 6 months or so, there will be some exciting updates from us in terms of the way that our protocol can help contribute to that future. Ways that, make it as easy as possible for agents to use LayerZero to not just move money, but to direct that money into the specific use case on the specific chain that is best for the user. Abstraction is hugely important, and yeah, we are doing a lot internally to contribute to that future, I think.
Cool, nice. Well, we're essentially at the end of the show. Maybe just one final question to wrap it up. Do you think agents will essentially lock in the dominance of essentially centrally minted stablecoins, just because it's so easy to move around and it's so convenient and there's so much liquidity? Or do you see agents benefiting the growth of more DeFi native primitives like CDPs and perhaps other stablecoin designs? Do you think it will have no impact at all, right? If you have to say, right, there's like agents like take over, it's going to stay today as it is, right? They're not really going to tilt in one or the other, like the general preference and adoption in one or the other direction? Or do you think there'll be like a very clear, like, okay, yeah, agents are taking over, it's going to be centrally minted stablecoins, and that's it? Or do you see the alternative happening, this being more of a boost for, I always use the term DeFi native for things that are decentralized at the core, and things like essentially Bitcoin, right? Things like CDPs. Although to be fair, like most CDPs today rely on essentially centralized collaterals. What do you think is going to happen in the next, if you look at 5 to 10 years into the future?
Yeah, I think it's important to distinguish between like two potential futures here. I think there is a future where there are fully autonomous agentic workflows that are happening on chain, where the computer behind these agents, the AI or the model or whatever it is making decisions about investing, about app usage. But I think what's going to come far, far sooner than that is agentic crypto as a tool, where instead of manually having to direct my funds, to interact with smart contracts myself, to buy gas, to bridge, to do all of these things, I'll be able to just tell, the way I see it in my head is like like a chatbot type experience, where I can tell a model to use agents in the background to like do these things for me in a way that I don't have to direct myself. I think that first, or that second use case won't have an overt effect on centralized versus true DeFi native crypto. I think it's much more correlated to again, the types of use cases and assets and users that actually exist on chain. My hope for the next 5 years or so of agentic finance on chain is that it'll just become much, much easier. And by easier, I mean less time consuming and less knowledge dependent to be able to access those things that already exist on chain. So I guess a small example, right? Like I have friends who don't work in crypto, but who saw like the Wall Street Journal article on oil futures trading on hyperliquid during the Iran conflict. Um, a lot of them asked me like, how do I deposit money? How do I trade on hyperliquid? And almost two-thirds of them did not get past the depositing stables step because they just didn't understand. They're like, what is arbitrum? What's a bridge? How do I deposit different assets? What's the difference between these assets? In a world where there's really strong agentic tooling within crypto, that becomes a non-issue, right? They specify that they want to trade this market, and then in the background, something autonomous works out how to get their even in some cases fiat currency on ramped, swapped into the correct stable, deposited, and into a position. That is what I'm paying much more close attention to, and I think again it'll just depend on the types of users who are actually utilizing these flows and the specific actions on chain that they want to accomplish with agentic workflows as well.
Cool. I think, I mean, I desperately hope that this will be possible sooner than in 5 years, but actually in a year from now, perhaps already. I think
Agreed.
we've seen quite a good deal of improvements and things that really simplify DeFi native actions through the use of essentially agents. Look, thank you so much for joining. We're at the end of the show. Hopefully, we'll see more cross-chain volumes powered by agents in the near future. We should reconnect in a year from now and see where we're at.
Yeah, let's do it.
For everyone listening in, thank you so much for joining. We'll have another guest joining us in, I think, a week or two from now. So stay tuned for the next episode of the Bullish on Bitcoin show. Follow us on Twitter. And yeah, have a nice Thursday. Bye-bye.
Thanks, guys.